IFRS 16, which came into effect in January 2019, marked a significant turning point in the world of corporate accounting. This new standard fundamentally changed the way companies recognize and report leases, bringing about a level of transparency that was previously missing from financial statements. Under IFRS 16, most leases must now be recorded directly on the balance sheet. This ended the long-standing practice of keeping many lease obligations off the books, which often made it difficult to fully understand a company's financial commitments. By requiring greater disclosure, the standard gives investors, analysts, and other stakeholders a much clearer and more accurate view of a company's assets and liabilities. This increased transparency enhances comparability between companies and supports better, more informed decision-making. IFRS 16 introduces a single, unified accounting model for lessees. Now nearly all leases are recognized as both a right-of-use asset and a corresponding lease liability, reflecting the true economic impact of leasing arrangements. The previous complex distinction between operating and finance leases has been eliminated. This simplification means accounting practices are now more consistent, reliable, and easier to compare across different organizations and industries. Implementing IFRS 16 required companies to overhaul not just their accounting systems, but also their internal processes. The transition impacted multiple departments, including finance, procurement, legal, and IT, demanding close collaboration and careful planning. Today, IFRS 16 is fully embedded in financial statements worldwide. Its principles are now essential knowledge for anyone seeking to understand the financial position and performance of modern businesses. In the following sections, we'll explore how this groundbreaking standard addressed a long-standing challenge in financial reporting and what it means for the future of business transparency. IFRS 16 was created as a direct response to a significant challenge in financial reporting that had troubled investors and regulators for years. Its main goal was to fix a major flaw that existed in the way companies reported their lease obligations, which often led to misleading financial statements. In the old IAS 17 standard, a practice known as off-balance sheet financing allowed companies to keep large amounts of debt hidden from view, especially through operating leases. Under IAS 17, operating leases were kept off the balance sheet, which meant trillions in lease commitments were invisible to investors, analysts, and even some company stakeholders. This lack of transparency made it extremely difficult to assess a company's true financial health, compare companies fairly, or understand the real risks involved in their operations. Companies could easily structure leases to avoid recognizing liabilities, distorting the economic reality and sometimes even giving a false sense of financial strength. Recognizing the need for change, the IASB and FASB set out to close this loophole, working together to create standards that would ensure consistent and transparent reporting of all lease obligations worldwide. IFRS 16 now requires nearly all leases to be recognized on the balance sheet, providing a much more complete, reliable, and comparable view of a company's commitments and financial position. With this major problem finally addressed, let's take a closer look at how leases are now brought onto the balance sheet and what this means for financial reporting going forward. IFRS 16's core change is that lessees must now recognize almost all leases directly on their balance sheet, rather than keeping them off the books as was common under previous standards. This represents a significant shift in how companies report their financial obligations and assets. Under IFRS 16, lessees are required to record a right-of-use asset and a corresponding lease liability for leases longer than 12 months, unless the underlying asset is considered low value, such as small office equipment or personal computers. The lease liability is calculated as the present value of future lease payments, discounted using either the interest rate implicit in the lease, or, if that's not available, the lessee's own borrowing rate. This calculation ensures that the liability reflects the true economic cost of the lease over time. The right-of-use asset is initially measured at the same amount as the lease liability, but it's then adjusted for any initial direct costs, lease payments made at or before commencement, and any restoration obligations. This accounting approach increases both reported assets and liabilities, which can significantly impact key financial metrics like leverage ratios and return on assets, making companies appear more leveraged than before. Instead of a single straight-line rental expense, lease expenses are now split into depreciation of the right-of-use asset and interest on the lease liability. This results in a front-loaded expense profile, with higher expenses recognized in the early years of the lease. As a result, EBITDA typically rises, since both depreciation and interest are excluded from this metric, potentially making a company's operating performance look stronger. Let's see how this new lease accounting model works in practice with a simple, step-by-step example to illustrate the changes. Imagine RetailCo signs a 5-year lease for a store, paying $100,000 annually, with a 5% borrowing rate. RetailCo calculates the present value of lease payments, about $432,948, and records this as both a right-of-use asset and a lease liability. Each year, RetailCo depreciates the asset straight line and recognizes interest on the liability. In year 1, depreciation is $86,590 and interest is $21,647, totaling $108,237 in expenses. The annual payment reduces the lease liability, with the interest portion decreasing over time. This process continues each year, with depreciation constant and interest declining as the liability is paid down. The result, a transparent, systematic approach to lease accounting. Now, let's compare IFRS 16 to the old standard. The key difference between IFRS 16 and IAS 17 is how lessees account for leases. IAS 17 split leases into finance on balance sheet and operating off balance sheet, creating inconsistency and lack of transparency. IFRS 16 eliminates this split. Almost all leases are now on the balance sheet, except for short-term and low-value leases. This change gives a fuller picture of assets and obligations, improving comparability. Lease expenses are now split into depreciation and interest, leading to a front-loaded expense pattern and higher EBITDA. For lessors, accounting remains largely unchanged. They still classify leases as finance or operating. This continuity avoids unnecessary disruption for the leasing industry. But what does this mean for companies in practice? 9. Lessees feel the biggest impact. Assets and liabilities rise, leverage ratios increase, and profit profiles shift. The new visibility of lease obligations has led companies to rethink lease versus buy decisions and negotiate shorter or more flexible leases. Implementing IFRS 16 required major investments in systems and processes, especially for companies with many leases. Lessors, however, see little change in their accounting, but must adapt to new customer demands for flexible terms and more detailed information. The standard has indirectly influenced lessor business models and contract offerings. Both sides now need a deeper understanding of lease terms and their financial implications. So, what are the key benefits and challenges of IFRS 16? 8. IFRS 16's biggest benefit is transparency. Investors and analysts now see the full extent of a company's lease obligations. This comparability leads to better investment decisions and more efficient capital allocation. Separating depreciation and interest gives clearer insight into financing costs and asset use. EBITDA rises, aligning more closely with cash earnings, but analysts must understand the underlying changes. The main challenge implementing IFRS 16 was complex and costly, especially for large organizations with many leases. Ongoing compliance requires robust systems and close coordination between finance, procurement, and real estate teams. Despite the hurdles, IFRS 16 has fundamentally improved the quality of financial reporting. Understanding IFRS 16 is now essential for anyone involved in business finance.